Here is the overview of today's gold market news. Gold price movements and technical analysis. Central bank and market influence. Economic and market reactions. Here are the recent gold price movements and technical analysis. Gold has achieved 28 record high settlements in 2024, driven by strong buying from Western investors and global central banks. The December futures contract reached a record intraday high of $2,538.70 an ounce and a record settlement of $2,537.80. Gold prices spiked to a new high above $2,490, reflecting continued investor expectations for a Federal Reserve interest rate cut in September. Earlier on Friday, gold had pulled back from a key chart resistance level in the $2,470s, but managed to break through to new highs during the U.S. session. Gold is attempting to settle above the $2,500 level, which is a significant psychological barrier and has tested historic highs recently due to a focus on falling Treasury yields and a weak U.S. dollar. A successful move above $2,500 could attract speculative traders, potentially pushing gold towards the next target at $2,550. Demand for gold remains strong, suggesting the potential for further upside momentum. Gold has broken out of its trading range from July and is continuing the bullish trend. A break above the range ceiling could lead to further gains. If gold maintains its upward momentum, it could reach new highs around $2,550. This target is based on the 0.618 Fibonacci ratio of the range's height. The market is looking for confirmation of the breakout with either a long green candle piercing through the resistance level or multiple green candles. This would signal a sustained move higher. Let's look at the central bank and market influence on gold prices. Central banks have significantly increased their gold holdings in the past 5 years, having absorbed approximately 10% of the global gold production. Since summer 2004, central bank gold reserves have grown nearly 19% by weight and have increased sevenfold in value to $2.4 trillion. The rise in gold prices is partly attributed to central banks diversifying from U.S. Treasuries amid concerns on the U.S. fiscal situation. This demand has been exacerbated by geopolitical uncertainty and a decline in other investment opportunities, particularly in China. Central bank gold purchases spiked following the sanctions on Russia, with central banks insulating themselves from the dollar's fluctuations. In 2022, central banks purchased gold at record levels, and the trend continued yearly, though recent purchases have slowed. China has been a major player in gold purchases, but has not announced new acquisitions recently, leading to speculations of discrete purchasing to keep prices restrained. The potential for both Western and Eastern buyers to engage in gold purchases could drive prices higher. This scenario would be unprecedented in the post-1971 era, when the gold standard was abandoned. Central bank purchases remain a major driver of gold demand and market sentiment. These are the recent economic and market reactions. Gold's earlier retreat was influenced by stronger than expected U.S. retail sales data for July, which showed a 1% month-over-month increase, surpassing economists' estimates of 0.3%. This data indicated a turnaround from June's 0.2% decline. Lower U.S. initial jobless claims, which declined to 227,000 from 234,000, further suggested economic resilience and contributed to a stronger U.S. dollar, which negatively impacted gold prices initially. Despite the positive economic data, investors continue to bet on the Federal Reserve reducing interest rates, which supports gold prices. Analysts have differing views on the economic outlooks based on retail and jobs data. One analyst cautioned against overestimating the positive impact of the retail sales data, where the economy might experience delayed effects before a potential downturn. Another maintained a positive outlook on the U.S. consumer and suggests that the strong retail sales and jobs data increase the likelihood of a 25 basis point rate cut by the Federal Reserve in September, rather than a more substantial 50 basis point cut.